Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Jeff Hobbs, CIO of Fixed Income at Voya Investment Management. Jeff, great to see you. Thank you for taking some time to chat with me. Looking forward to our conversation.
Hey, Todd. No, thanks for having me. It's good to see you.
So maybe if we start a little high level, from the Voya vantage point, how would you guys define the key differences between traditional fixed income, asset-based finance, fund finance? It feels like, from my perspective, everything's kind of converging and the lines are becoming increasingly blurred today.
Yeah. I like to, when people ask me kind of what we do here, right, I like to tell, especially non-investment professionals, that, hey, I've got 200 fixed income people. We oversee something like 200 billion, but we really only do four things, right? We lend to companies, we lend to governments, we lend against real estate, we lend against different forms of assets. So I think of traditional fixed income as publicly distributed bonds that do those forms of lending and relatively standardized, often publicly rated structures, right? So there are a host of risk factors, but the principal one is issuer credit risk. On the asset-based finance side, your primary underwriting lens there is going to be cash flows of a specific asset or a pool of assets that's often amortizing, set up in a bankruptcy remote vehicle. So in addition to credit risk, there's some structure and complexity risks that you want to get compensated for, illiquidity that you want to get compensated for. On the fund finance side, your risk is to the fund structure, right? And its underlying collateral. You're going to care about the strength of the manager, the variability of the underlying collateral, your starting, leverage point. So you're right to say the lines are blurring, especially across public and private assets, but that's kind of how I think of those three assets, more broadly.
And, where would you say we are in the cycle of those strategies today? And how does that ultimately shape your allocation decisions?
So I tend to think about the underlying factor risk, right, and where it is in its business cycle. So for corporate credit risk, we're very likely mid to late cycle. It's hard to envision credit conditions materially easing when you have valuations on the public side of our business near historically full levels. There's going to be changes in the composition of the lending base in private credit. So the reduction in private in retail capital we've seen in private credit, for example, concerns around AI displacement risk and enterprise software. That could create some supply-demand imbalances that widen spreads or improve structure. So corporate credit I think of as mid to late cycle. If you think about something like commercial real estate related risk, I think that's relatively early cycle. That's unique, right? Commercial real estate tends to lag the corporate sector since lease cash flows for retail industrial office are tied to corporate tenants. So the impact of higher interest rates and secular pressure on office causes commercial real estate to correct first. And that creates interesting lending opportunities today. And so I think that market's early cycle. You could think about something like the NACREIF, right? Which is peaked in the third quarter of 2022. It's still down a high single-digit percentage. Equities, have more than doubled over that time period, about 4 years. So you can lend in commercial real estate at wider spreads with higher rates at lower leverage points. That's interesting and different from high enterprise values and corporate credit. So that's corporate credit, that's commercial real estate. On the consumer side, you tend to think about consumer health as going with employment levels and the business cycle. So overall consumer leverage and debt service for households are still manageable. There's a lot of discussion about the K-shaped economy, which makes it a different answer for different, consumers.
Mm-hmm.
And so high income consumers probably that are benefiting from record household net worth, and they're probably more mid-cycle. And you may have some pockets of the consumer that are seeing a weakening labor market stretched with things like higher gasoline prices. They may be in actually recession here. And so at the factor risk level, you're in different parts of the business cycle. And so I tend to think of it across those food groups rather than thinking about business cycle between fixed income, ABF, and fund finance.
Obviously you touched on the private credit piece. We just had an event in Nashville last week. I mean, have you had any material changes into how you view private credit? And obviously when we mention private credit, we're focusing more on the corporate direct lending. That's had some of these hiccups or issues. I don't think it necessarily has been a crisis as maybe the media has portrayed it, but has there been any change in how you guys are viewing that sector these days, given a lot of the headlines and the noise around it?
Yeah, good question. So, direct lending it's having a moment in its evolution as an asset class. So with high single digit cash on cash returns and, low vol in the equities, it's still going to make sense for different pockets of capital over time. So the asset class has grown in a nonlinear line since the financial crisis. Is it going to need to evolve? Yeah, of course. What you're seeing today is a rebalancing away from some retail investors, and I think some of that's rational. If you can get liquidity at NAV in a semi-liquid fund and buy similar risk in a public BDC that trades at a discount to NAV, right, that trade makes sense at some sort of scale. Ultimately, the return profile of the asset class it's going to make sense for different pools of investors, right? A lot of folks want high single-digit returns with low vol. So what you're likely to see, unfortunately or not, is continued consolidation at the top end of the market and continued, especially lenders at the lower end of the market, and true direct lending where they're sole controlled lenders. And because, Todd, you used the word headlines in your question, right? I think what some people are not talking about is the confluence of challenges in private credit that are occurring at the same time as evolution in another market, and that's financial journalism. So think about my seat here in Atlanta. Our daily newspaper, the Atlanta Journal-Constitution, just issued its last printed publication at the end of 2025. So it ended a 157-year run that dates back to just after the Civil War. 25 years ago, it printed, the Constitution printed in the morning, the Journal printed in the afternoon. Now they don't print at all. And so could some of the sensationalistic headlines around private credit be because of a need for interest in financial articles? Yeah, I think that there's something there. Mm-hmm. And will some of these more sensationalistic headlines fade away as realized performance exceeds these kind of breathless worst case scenarios? Also, yes. So, private credit's going to need to evolve. Financial journalism is evolving. And you may have a kind of a moment in time where the confluence of those two things is creating volatility. Well, you think about broad, St. Louis Fed, like financial stress index would say, hey, over the past 25 years, financial stress is actually below average right now. And that doesn't read the same in the headlines.
Yeah, that's for sure. And I think there's also been a conflation about private credit, which was traditionally just direct lending. And now private credit today can mean anything from direct lending to ABF to fund finance to whatever. And so I think that's also been conflating some of these issues as well.
Yeah. Some of that's the bane of my existence, Todd, in that we have a largely private investment grade platform.
Yeah.
So I get questions from, outside investors and Voya Financial, clients, prospects that are hearing some of the headlines in private credit and not understanding, right, that the investment grade forms of our lending, we've done for, many decades preceding, right, the growth in the direct lending market
Yeah.
that's really happened, post financial crisis.
So you referenced, kind of those four main things that you guys do as CIO fixed income, kind of what does, as for the audience, cover your remit, and how differently, I know you've been at Voya about 13 years, how differently do you guys look today than maybe from when you started,
Yeah.
given the growth in some of these markets and obviously the convergence that is coming more? What does the kind of the firm look like today?
Yeah. So Voya Investment Management is now 350, 360 billion of assets under management. A little over half of that is under my remit as CIO fixed income. And that roughly splits between 100 billion of insurance related assets. That includes our $40 billion general account, and another 100 billion of non-insurance related assets. So think non-insurance institutional accounts like pensions, mutual funds, our active ETF, business. So by asset class, we have 53 billion of private fixed income. As I mentioned, that skews towards investment grade. We have another 45 billion or so in public corporate credit. So think of us as 100 billion in investment grade corporate credit. We have another 25 billion across high yield, broadly syndicated loans and a smaller private high yield capability. We have a $15 billion commercial real estate credit platform. We have a $30 billion securitized platform. That's the whole kind of host of alphabet soup stuff on the public side. We have another 5 to 6 billion in mortgage derivatives. I'm trying to do the mental math to get us to 200 billion. The rest would be, cash treasuries, other govies, EM debt. So my remit is overseeing the Atlanta-based fixed income business. So that includes our public and private capabilities. We brought those together last year as I became CIO of our combined, fixed income, platform, and that speaks to the convergence you're seeing in markets. We wanted to have those platforms together. My remit excludes our CLO platform, which sits in Scottsdale, our income and growth platform that sits in San Diego. So you mentioned, what looks different in the business today versus when I joined. It'll be 14 years in a couple months. So I joined in the summer of 2012. It was the last year as ING, right? So we were splitting off from a Dutch bank. We were going to be a standalone insurance and asset management business, in the U.S. The business has really, right? We, at the Voya Financial level, we spun off our variable annuity businesses. We later spun off our retail life business. The investment management business has probably tripled in size over that period. And we went from being primarily proprietary insurance, assets to where, that 360 billion of AUM, we manage, right, 8 times more externally than we do for our $40 billion balance sheet. So the Voya Financial business, the insurance business has really changed. The asset management business has really, scaled. So the business has evolved with markets, and I'm excited about what we have ahead here.
So you referenced it early in one of your comments when we were talking about kind of a little bit of the overview of the business and where you guys are allocating money. But is structure becoming, even more important these days? When evaluating, ABF and fund finance as relative to the bonds, like is structure becoming a greater piece to the puzzle in today's market, or has it always been?
Yeah, I think structure is always going to inform your underwriting risk. So I tend to think about in things like asset-based finance, you're going to think about the underlying asset risk. Whether it's a consumer asset, a real estate asset, a credit asset, what does that asset risk look like in a historic stress scenario? And that's going to inform the leverage level or over collateralization level you're comfortable lending at. So you want to think about what is asset volatility and how much should you get paid at various distances to the tail of that volatility distribution. That's the question. So your question on structuring, right? Covenants, liquidity features are meant to de-risk you when you're in that tail of the volatility distribution. So amortization triggers, cash traps, et cetera. You want your liquidity coming from the structure and private assets, and that of course differs from our our public fixed income business.
In recent years, there's obviously a ton of money that's flooded into a variety of these markets. And, you start to, and I've talked to people about, deal and doc deterioration or deal terms changing because of this new capital coming in, whether they're called tourist investors or just the abundance of capital being there. Um, do you guys ever, change how you potentially participate in transactions given someone might say, hey, we can get this deal done doing it this way versus that way? Or is there kind of a set path as to how you guys look at these transactions and perform investments, due diligence, etc.?
Yeah, there's never really kind of a set path. So I talked about the evolution of our of our business. So from more proprietary capital to more third party base. So that means that you are trying to make sure that you're driving the right risk and relative value for a whole host of constituents. But the structural pieces of it, there are certainly non-starters, right? There are going to be places where the teams put the book down and say, hey, with that structural feature lacking, right, that the absence of that covenant doesn't make sense for us.
Yeah.
Um, and I think one of the things that's benefited us is our investment teams grew out of serving a proprietary balance sheet that's that's inherently 10 or 11 times levered, right? So you're always worried about downside protection. That hasn't changed, right? A lot of the third party clients that we're serving are also levered balance sheet, other financial institutions, and you want to make sure that you're delivering the right risk adjusted returns.
The downside protection piece, obviously, if people are moving money to asset-based finance away from or diversifying away from the traditional corporate direct lending, is that a greater appeal in the asset-based finance space, given some of the more of a headline issue, but still investors tend to allocate away when it's bad headlines to a market. Is that becoming a greater appeal to the asset-based finance space, given the downside protection is such a core element to it?
Yeah, I mean, downside protection is a core element of private credit too. That's often senior secured lending. A lot of the loss rates for private credit shops start with a zero. Today at least, right?
Yeah.
Our we've been asset-based finances has been a little bit of a buzzword, but our private fixed income teams have done forms of asset-based finance lending that dates back decades. And so could you see more capital move from middle market direct lending into ABF? Yes, you tend to see that in credit cycles where you have some amount of investors kind of high grade what they're doing. So you could have people leave middle market direct lending and move up into various forms of private investment grade lending. That would be interesting for us. That's obviously where we have a really big platform. You also have changes in the shape of the curve when you're raising a ton of money at 6 to 7% yields in direct lending, and when rates were zero, right, you can get 6 to 7% yields with base rates higher in investment grade fixed income today. And so I think you're going to investment grade private fixed income, including ABF. I think you'll see some investors make that switch.
When comparing, I guess maybe I'll ask this question first. We recently did a survey in fund finance, asking people where they kind of bucket fund finance. Is it a strategy unto itself, part of ABF? Ultimately, they said, in at least in those that we surveyed, just past ABF. It was a strategy unto itself, and the next biggest category was ABF. Do you guys view it, fund finance, as a strategy unto itself, or is it a piece of the ABF puzzle?
Yeah, we think of it as a strategy unto itself. Like, so for our internal proprietary balance sheet, we have separate kind of risk limits and measures around fund finance. We, as far as the teams that are underwriting fund finance transactions for us within the private fixed income platform, they sit within the ABF vertical, right? But fund finance is a big component of it, and we we have dedicated people that are going to do the fund finance transactions, and we segment it within our proprietary balance sheet in a particular way. And then when you're thinking about risk and relative value, you're often thinking about fund finance as an alternative to where you could get that same underlying asset risk exposure and leverage point in public markets. So that makes for a direct comparable. So it's somewhere right in between what's happening in ABF land, what's happening in say public CLOs or other securitized asset classes depending on the underlying.
Is there any particular characteristics that help differentiate platforms that might succeed in ABF and fund finance versus those who don't?
To succeed, I think you need to know who you are, right? That seems pretty simple, and maybe it sounds existential, but I think of there as three components, and maybe that's because I was on like an energy-based lending call here earlier this morning. But think of those three components when I think of sourcing, underwriting, structuring, distribution, like upstream, midstream, downstream, and in energy. So I'm giving you the long version of this thought. So on the upstream sourcing, right? Are you going to own origination engines? Are you going to be more diversified in your sourcing and less captive to your own internal origination? So on the midstream part of it, how good are you on the credit underwriting side? Do you have internal structuring resources? And then on the distribution side, like who's your capital? Where's your capital coming from? Do you have affiliated captive balance sheets? Do you have longstanding client accounts? There are certainly those in ABF land that just have fund capital, and they can get caught in a cycle of not being great partners to borrowers where they're sourcing deal flow. They may be kind of start stop on deployment, which makes underwriting trickier. So you got to know who you are. So we don't own origination, which is more consistent with our approach as an asset manager that wants to deploy flexible capital based on risk and relative value. So the midstream part, we have great underwriting depth. We've got some folks I think that are quite special. We're not nearly as good at the structuring part, in part because a lot of the transactions we've done historically have been syndicated or club deals. And the distribution, we have captive balance sheets. We can always be in the market. And we have tremendous end client accounts, but they are certainly more narrowly focused in investment grade rated transactions because of our heft in the insurance channel. So I think we can be really successful. We are really successful in the corner of the market, right, that we're in, and we're which is sourced in an omni-channel framework by deep collaborative internal teams with investment grade balance sheet and distribution. And so I see a lot of guys in the market that are caught in between some part of that, right? They own a little bit, but not a lot. They've had high turnover in their credit underwriting resources as there's been a lot of interest in this space. They don't have consistent in distribution or a captive, balance sheet. And so they're in it. They're trying to get transactions, done with partners, but they don't know exactly who they are. They may know who they want to be, but they haven't been able to kind of put it together. Does that make sense?
Yeah, no, that does make sense. I mean, part of the reason I asked the question is, we've certainly heard, a lot of new money coming into the space, some going in and out of different strategies, trying to capture maybe where the hot market is. And curious if that type of strategy is having success, or if it's the ones that, as you said, know who they are, that tend to be mainstays and specific to, hey, I'm an ABF platform, or hey, I'm a direct lending platform, or we have an ABF dedicated, pool of capital. Or it feels like the different strategies and those that might jump around a bit more are not having nearly as much success these days.
Yeah. So I think in some degrees you want to be able to jump around, and that when there's interesting relative value decisions to be made in a subsegment of the market, you want to be able to concentrate your underwriting there, but you have to have consistent capital to do that, right? You have to have consistent downstream distribution, the pipe to the home. And because if you're continuing to raise opportunistic funds for every time there's an opportunity, um, it's very easy to miss it. And you could get the capital raised, and all of a sudden the lending opportunity is moving somewhere else, and you've told in client capitals where you think the opportunity is, and then I feel like you're chasing it. So
Yeah.
you want to be flexible. There's definitely people that are only captive origination platforms, and that model means that that's where you're going to deploy capital, even as risk and relative value changes in the market. So you want some degree of flexibility, but you've got to be able to connect those three upstream, midstream, downstream components successfully to be able to do that.
If we look specifically at fund finance, which has obviously grown pretty exponentially the last few years, is there any particular area that is most compelling? Obviously, subline still dominated very much by banks. You have NAV lending, more CFO issuance these days, hybrids, securitization is coming more. I mean, how do you view the fund finance space today and the growth that it's seen?
So from a risk-adjusted return standpoint, right? You mentioned sublines. Sublines are tremendous risk, right? You're getting high 100s spread, maybe low 200s. So think double B corporate credit risk in this environment for an asset class that really hasn't had any losses and
Yeah.
institutional quality deals over the decades long history of the asset class. So some people are like, well, finance is a newer thing. Sublines have been around forever, right? Institutional investment managers like me just didn't participate in them because banks dominated it. Now, regulatory reasons have had banks pulling back. That's really interesting. You aren't taking credit risk in that. You're providing a liquidity solution to a fund that is inherently more liquidity constrained. For people to have captive balance sheets like us, you're supposed to do that. So for a lot of the capital types listening, that is probably just uninteresting, right? High 100s, low 200s, like probably doesn't move the needle. They don't have capital with as low of a cost of capital as we do with our insurance franchise.
Yeah.
Um, NAV lending, which certainly has a ton of different permutations and risk profiles, we think offers good relative value for people that have sourcing and underwriting capabilities. So upstream and midstream. So I reference, I think there's really good opportunity in, commercial real estate lending that's more, opportunistic. We've done a lot of, of GP, securitizations over time, that have had relative value. Banks are starting to compete harder there. And so that opportunity may, prove more fleeting, but there's lots of interesting opportunities, in fund finance. It really depends on where your, capital is trying to play in the spectrum of risk and return.
What about the private credit fund lending to other private credit funds as a potential risk for the market? Because, I mean, conceivably, one private credit fund that looks like another
Yeah,
could potentially lend to it. And then it brings all kinds of conflicts in there of like, Chinese wall, how
yeah,
much do you know about someone's strategy? Because there's a lot of commingling, it feels, of these lenders that have now kind of exploded on the market the last couple of years.
yeah, yeah. So certainly people are looking for ways that risks can start to autocorrelate. There was a story on Bloomberg a couple weeks ago about the back leverage facilities at JP Morgan. And it was shocking to me that it was on top stories because it feels to me like a more kind of niche corner of the market. We talked to the team at JP Morgan, and it's a wonderful business, right? They when I talked to them a couple years ago, they had and maybe Todd, we're supposed to talk about this as a very large money center bank, uh, but this money center bank had $31 billion facilities to large private credit funds, and they were doing lending at the time, at something like a 65% advance rate with a hard default at 74%. And that money center bank, um, was also the collateral valuation agent. So they got to tell you what the V is in LTV, and they had a hard covenant that said that when something was a default, and that's a wonderful business, right? And so they were lending it at kind of mid 200 spread, and so I joked with this bank like, hey, we have a big balance sheet that has lots of public assets. Write me a committed repo line at 50 basis points spread for multiple years. I'll lend back to you at 250. You go do this thing, which you're never going to lose money at because you have significant equity cushion behind you and you're the collateral valuation agent. I'll make 200 basis points spread, for our balance sheet. That's high teens equity returns. And I'll just move to the beach and I'll stop working so hard. Right. And so I told that story to this banking partner in part to figure out, well, why are they offering it out? Why are they offering participations in these facilities out to people like me? And the reason was the banks at the time, banks can be in the moving business, they can be in the storage business, and that bank at the time was in the moving business. They wanted to clip an OID and create capacity and go do more lending. So you are in a situation where, as regulatory pressures on banks change, you could have banks more in the storage, business and doing more of that lending direct on balance sheet, and that could crowd out, right, the private credit lenders to each other if the banks are back in that space in a big way. But I never looked at that situation and said, "Gosh, banks lending to private credit funds is a contagion." And when the story on that particular bank suggested that they are marking down the valuation of certain loans, it's like, well, of course they are. They're the collateral valuation agent, and it's helping protect their downside risk. And so, private credit, firms lending to other private credit firms, us as a non-bank lender, right, with a private fixed income platform, we certainly lend to other, private fixed income organizations, but we're doing it at a delevered point that we think is demonstrably, loss remote. And it's often those private credit firms have institutional capital that wants to have levered exposure to the underlying, right? And so we're adding delevered exposures. So the risk in that situation really lies with institutional capital that may not have the returns to their equity that they expect to have. And but it's the right question for the market to be asking, but it doesn't feel like that's a well-founded risk to me.
Okay. Before we get to some fun questions, one final one on the markets. Are there any particular innovations or structural developments you think could further accelerate growth in either traditional fixed income, ABF, fund finance?
Hey, these markets have grown really fast, right? So the forward pace of growth in these markets is going to be driven by the direction of travel and bank regulation. On the end kind of client demand side, the industry may need to relook at the vehicles for some of these asset types. So I think the private credit interval fund with 5%, liquidity at NAV quarterly was an elegant solution, right? You can't have daily liquidity.
Yeah.
Vehicle where part of the source of the return is illiquidity. So the industry offered some liquidity at regular intervals. Investors are pushing back here, right? Retail investors have decided they don't necessarily want that. So can there be another structural innovation that the market delivers that allows investors to capture these structural premium, meet the desired risk and return profile? So I think that's something that could be a structural development in the market. So bank regulatory changes influence growth, product development influence the composition of end investors. That's how I'd couch it.
I guess one final question on that. I mean, I know the retail investors are pushing back, but could it also have been that they were sold something that they thought maybe they had more of from their IRA or private wealth, and they're thinking, oh, I've always gotten my money back from these, but now that everyone wants their money back, the gate has to come up. And so maybe there's a miseducation there on what the product was to begin with.
Yeah, there was likely maybe not a miseducation, but a misunderstanding. And we saw that with commercial real estate related funds, 5 years ago, as you started to have pressure on commercial real estate. Again, back to my, hey, commercial real estate cycle's in a different place today. So it was kind of evident that this issue could happen, but it wasn't something the market focused on until it became an issue.
Yeah.
And ultimately, like retail investors going to want a high single digit cash on cash return with lower volatility than the equity market? Yes. Huh. If private credit can help deliver that in a form that investors can get comfortable with, then you'll see the market move to whatever that solution is. But ultimately, the risk and return profile, I think, makes sense for certain pools of capital, and you just gotta. We may have to have a structural change in how that's delivered to the retail investors.
So now we move on to some fun questions.
All right.
I know when we initially spoke about this, you had mentioned college football. Certainly,
Well, I heard this podcast, and you like to talk about it, so
yep.
that's certainly one of my passions. Certainly.
So, would you say the sport itself, while I know ratings are up and obviously interest in watching it is higher than ever before, but it feels like it's in this like precarious position of like, will it actually survive?
So I love college football. I went to undergrad at the University of Oklahoma. So my wife, who also went to OU, we try to make a couple of games a year to see friends. Fortunately, with the move to the SEC, right, the games are coming to me. We run our fixed income out of Atlanta, so that's nice.
Yeah,
I would say the sport is in an exciting. You said precarious. I'd say tenuous place, right? And I
yeah,
think that the challenge is the combination of NIL and less restrictions in the transfer portal means you have players that are playing at 3 or 4 schools, right? You could probably have one of those things, name, image, likeness dollars to pay these kids or transfer restrictions, but you have both, and it's just created free agency in college football, and we've quit pretending that these kids are student athletes, especially with the geographic dispersion that we now have in a lot of these
yeah,
conferences. And so the roster turnover hasn't hurt fan interest to date, right? People want to root for their alma maters like me, but if these players are viewed as pros, there's a long run risk that NCAA football is viewed as the Saturday equivalent of the NFL with just worse players, right? And I think that's happened a little bit in college basketball. You see even more player turnover,
yeah.
so that's certainly a risk for football. But as the money flows in, you know, it's a businessman's perspective, right? There's like the tidal wave of liquidity that's going to come to this space is going up, not down in the short run.
Do you think we're inevitably moving to a super league where like the lower rung of the sport is kind of cast aside and it's I mean it feels like we have that a little bit with obviously the SEC and Big Ten now,
Yeah.
but like a traditional like hey here's the super league and the other lower level leagues or lower conferences are basically just taken out completely.
Yeah. So, hey, college football looms large in the Hobbs house, and there's been like some interest from legislators on this topic. I hope they're focusing on other items as important as college football is to me in Utah.
Yeah.
As far as heading to a super league, I grew up in Muncie, Indiana, right? So you have a Notre Dame ties, so we both have Indiana ties, and so
Yep.
Muncie, Indiana is home to like an FBS major college football team. It's the Ball State Fighting Cardinals. So 4 or 5 years ago, I think it was OU had a Thursday night game. Maybe this was before Labor Day, and Ball State had a Saturday game, and I ended up going to both, right? And I was sitting in the grass behind the end zone with one of my childhood friends in Muncie. We had our kids there, and it was very clear that while OU and Ball State play in the same sport, they are just massively different levels, right? And I
Yeah.
I find it very difficult for the mid-major teams to compete in this new paradigm. If they develop talent really well, a major college football team is just going to buy those players, and the resource gap is only going to accelerate. Um, it I wish, Todd, like you would see something akin to like promotion or relegation in English football, right? So you don't want Ball State investing heavily in its football program and have that crowd out academic resources, other programs. You want to see them able to capture some economics of great performance if they have consistent success. So the money in the sport is going to be concentrated in the upper echelons of the sport, but you should have to earn your way into that run and not just have it based on historic conference affiliation. So if Ball State has a great run, and say another Midwestern team at Northwestern disinvests from their program. I want to see Ball State get part of the spoils, and Northwestern have to earn that largesse that's coming. It's tens of millions of dollars coming from these big leagues, and so I think you could set it up regionally: the Big Ten, MAC, SEC, Sun Belt, Big 12, Mountain West, something like that, where you have the conference champ of these lower leagues gets promoted, gets relegated. I think that makes some of these late season games for non-contenders super fun.
Yeah.
And, it probably actually keeps the major leagues, the major conferences, Big Ten, SEC, away from some sort of antitrust litigation, which it feels inevitable.
Yeah.
So if there's a major football game in Muncie, Indiana in November, a chance of promotion to Big Ten, all podcast listeners here have a tailgate experience and tickets on me, right? So if that happens, it'll be so exciting. And if Oklahoma is at risk of getting relegated any time in my lifetime, forget that I ever brought this up, but I think it'd be super fun. So.
Do you think Oklahoma, obviously they went to the playoff last year, but what are your chances for the upcoming year? Are you confident?
Winning it, baby. Yeah.
I think Notre Dame will have something to say about that as well.
Right. That's right. Hey, Notre Dame had 2 running backs go in the first round of the NFL draft. I can't remember another time that's
third time ever that's ever happened.
There you go. You knew the answer. So,
yeah.
But I'm bullish on Oklahoma. So that has not been the right answer since like 2000. That's the last time they won it. But I think in college football, part of the difference between big teams and the super conferences and the middle market teams is the line of scrimmage, right? Yeah. There's only so many 300-pound kids that can move, and the teams that can agglomerate them tend to do very well. And you had a really young offensive line. 3 freshmen played on a playoff team, so they should be better this year. They've got a great defensive line, so I think they could be good on the lines. Venables is great on the defense. The quarterback John Mateer was good early, got hurt, and then kind of struggled. But I'm excited about their prospects this year. So we'll see how it goes.
Couple more questions as we wrap up here. One surprising thing about yourself.
Well, I'm a twin, and so I have a twin sister that is a math professor at Butler University in Indianapolis. So she, Indiana ties,
there you go.
Here. And so I told her once, like, the fixed income part of our job, she teaches business calculus. And I tried to explain, hey, the, price yield function, in fixed income is something called duration. It's the first derivative of the price yield function. The second derivative is something called convexity. I have teams of people that think about duration, convexity all the time. I'll go talk about a real example of business calculus to your students. And I told her that. She was like, that sounds so boring. So I never got pulled in to talk about fixed income with her calculus students. I've told her before, like, hey, your math skills are very desirable in this thing that we're doing. I was talking about distance to default, right? As versus asset volatility. These are math concepts, and I think she'd do great. But she's she's very comfortable what she's doing. But I've got a twin, and it's a little bit unique. Some of our clients aren't aware of
that. One book you'd recommend reading?
One book. So, I've got 6 and 8-year-old boys, so I've been reading a bunch of Dog Man, which is like
I know those well. I have a 7-year-old boy.
Yeah, so. There you go. Yeah, I have a bunch of different stuff on my nightstand, and I kind of go back and forth depending on my mood. So, 1929's on there, which is really interesting historical perspective. I'm looking through that as what parts of that story rhyme with today.
Yeah.
How to Invest with David Rubenstein is on there. Dave Bergazzi's Big Dumb Eyes is on there. Recently, Matthew McConaughey's Green Lights is on there. Both of those books, Bergazzi and McConaughey, I read in their voices in my head, which is kind of weird before bed. There's some nerdy books on there, like there's Harvard Business Case on mental toughness. There's this book called The Culture Code, which my father-in-law gave me, which is really good. Coach K's books on there that came from a business relationship that had him come speak. A lot of different, stuff on there. It really depends on, kind of mood I'm in at the time.
Most exciting part of your job?
We talked about college football. You saw me getting excited about college football. So, I love that our business has a scoreboard, right? If you're not performing, the business atrophies. And so, any credit person that you have on this podcast loves their internal credit committee. We just had ours on a real estate related transaction. I love seeing the different deals in the meeting on the private credit and real estate parts of it. The committee to me is where we shape our credit culture. It's also this living, breathing thing, right? I chair it today. Our old CEO chaired it. The CEO before him was on it. There have been dozens of really kind of great credit people over time come and go on the committee. And so we've got great people. It's always fun interacting with them. And then the other exciting part of my job is just, podcasts, especially ones where we talk about football. So.
And then final question, one prediction for the next 12 months that is not Oklahoma winning a national championship.
So, when people talk to me, they've only really wanted to talk about two things recently. It's been Iran and private credit, right? Yeah. So I'll give you a prediction, for both of those. And so, one prediction would be that 1 year from now is lower than where we started the Iranian conflict. That has implications on inflation, nominal rates, consumer spending, economic growth. Would narrow the divergence we've seen between energy importers and exporters. So oil's a year from now than when the conflict started. On the private credit side, we hit on this a little bit, but you had a ton of money flooding in, in the back half of 2020 into 2021. Really easy credit conditions. That money really wanted mid to high single digit unlevered returns in a world of zero rates. And it feels like today, the things that haven't been able to successfully refinance, there's a bad vintage of loans in there. Just weak structure in a period of easy lending, much tougher interest coverage given that rates have risen. So I think some investors are going to look around the world and say, hey, I can get 6 to 7% in private investment grade deals. Let me look more in that area. Traditional privates, project infra, IG rated ABF, fund finance. So we've put something like $25 billion to work in those food groups since the start of 2023, and that yield has been something like 6.3, 6.4%, triple B plus quality, intermediate duration. So I think you're going to have some money move, up in quality in portfolios as you see some private credit investors decide they're with higher base yields, they're going to move out of the more speculative grade parts of the market.
Well, Jeff, this was a lot of fun, especially the football part, which I don't get to talk to a lot of people about. So thank you.
Good luck to Notre Dame. So
right back at you.
I grew up in Indiana. I didn't make it to South Bend for a game until OU played there. Maybe it's probably been a decade now, and
it's been a while.
It's a wonderful, special place to go. Watch football. I've had friends that went to school there and think very highly of it. So good luck to the Fighting Irish next year.
And right back at you, Boomer Sooner.
All right.
Thanks, Jeff.
Man. Yeah, see you, man.
Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.